So how have you changed HOOPP, and how has the pension industry in Canada in particular changed in the time when you first came in 1999 to now when you're leaving?
So there's a few big things. I mean, we've pretty much insourced all of our activities. So we have our own in-house pension investment management staff that runs virtually all of the money. We still have some partnerships outside, but most of the money is run directly by our own staff. And that has huge advantages in the sense of it's much more cost effective.
Right.
So paying people to run money for you is significantly more expensive. And just to give you an example of that, when I first became the chief investment officer, we had about 15% of our money run externally, and when I insourced that, so that 15% cost more to run than the other 85. And actually the returns were not as good. And one of the other intangibles is that you sort of sacrifice control of your risk management because when you give money out to other people, they're going to do what they want with it, and your choice is you can take the money back or leave it with them. And so whereas internally, we can, if we're not comfortable with the market, we can dial the risk up and down quite easily.
And you say 15 was more expensive than 85.
That's right.
That's astounding. I mean, because that, again, when one of the key things, we'll talk about your the framework of how you look at the pension industry, but one of the things that I thought was extraordinary is about the cost versus an individual. I mean, that is a cost savings that you can't make as an individual if you're investing on your own.
Yeah, so our investment costs are about 20 basis points, or 0.2% per year. Mm-hmm. And when we looked into what individuals pay, and it's typically somewhere between 2 and 3% per year, so 10 times as much.
Right.
And that difference of 180 basis points, I mean, it doesn't sound that much annually, but you start compounding that over 40 years, and you actually end up with half as much money.
Right.
So I mean, when I first saw that, I thought that can't be right, and I did the calculation myself, and in fact, that is true.
Right. The magic of compound interest. Yeah.
It does make a huge difference over time.
And what other things have you seen? Because I think that the industry's changed a lot. I mean, essentially, you came in from an industry. You brought your expertise. My sense is that in order to have people of that capability, you have to pay them the going rate. What sort of staff do you have in terms of trading and risk management and things of that nature?
Yeah, I mean, we really have top-notch staff. I mean, we're really some of the best people in the world, and we pay them market rates. And I think that's one of the big challenges that the U.S. funds have is the governance structures don't allow them to do that. Mm-hmm. So there's some very large pools of capital in the U.S. that could be run the way we run our money. All in-house staff. But the structure of most U.S. plans is not independent. I mean, it's a lot. If you look at a lot of the state plans, they have politicians sitting on their boards and stuff, and it's politically unacceptable to pay people in-house a check. Yet they'll write a check to an outside manager that's 10 times as much because it's kind of depoliticizes the payment.